Hey guys, how are we doing? It's Cryptoinsightuk UK bringing you back another video here. So I'm going to go into a deep video today. I'm going to cover quite a lot of different topics, all the way from traditional markets, my views on traditional markets, some of the things that are happening out there right now, like the Fed, interest rates, inflation, that sort of thing. Then I'm going to finish with some crypto, TA, and my thoughts on the crypto markets. So without further ado, I'm just going to get into it. As I said, it's going to be a long one, but also take into consideration that I am a complete idiot. Everything that I know, I've literally taught myself over the last 5 years, doing this full time for three and a half years. I was trading, probably been trading for badly. I was trading for a year or two and then took it more full time. So let's see what happens. I'll just talk to you about what I can see. I probably have gaps in my knowledge. I'd like this to be filled in by people. If you have deeper understanding, that'd be sweet. Comment on my video. But yeah, let me just explain what my thought process is. I've been writing newsletters for the last year in depth. They've been quite accurate about the future. So you can always go back and have a look at them on my website, Weekly Insight UK. Everything's published there. I think I've done 41 episodes now with my co-author. But yeah, go and have a look at them if you want to have a deeper understanding of my long form text. And without further ado, I'm just going to jump into this vid. So the big news yesterday in the markets was the Fed pausing interest rates, but they said they're going to hike likely later in the year. There was a discussion about them hiking in July, but we'll see if that happens. They're basically saying they're waiting for economic data. The whole thing, the whole narrative for Jerome Powell specifically in the Fed has been to bring Fed fund rate lower than interest rates, and then they can basically then they're winning the battle against inflation, and they're cooling inflation off. If we look at what inflation is now, inflation's at 4%, and Fed funds are 5 to 5.25. I'm going to just jump into what's happened in the past when the Fed have paused rates, and what we might be able to expect in the future, and where it might differ from other times in the past potentially. I think we're a little bit different this time than we have been in the past. But yeah, let's continue with that thought process. Before we jump into the Fed, talking about the Fed pausing and reversing interest rates, I just want to let people know that US debt is currently $31.5 trillion, with interest rates at 5 to 5.25%. It's $1.5 trillion a year in interest that they have to pay, which is reportedly around a third of their spending limit per year, and as much as they spend on their defense budget. So as much as interest rates might need to be high to tame inflation, it's not easy for the US to keep interest rates high for a long time when they've got this much debt. And this is one of the big differences between now and the past, in my opinion. I think in the 1980s, and I'm just pulling this number out of the air, so someone correct me if I'm wrong. In the 1980s, I think debt was around 3 trillion, and now we're 10 times that. That was when interest rates went all the way up to double digits and almost towards 20% interest rates. I don't even know if they crossed 20%, but they're at 3 trillion for their national debt, and now we're 10 times that national debt, meaning that just 5% on their national debt of 31.5 trillion is over 1.5 trillion. Just to service the interest on that debt. So that's things to take into consideration. So now I'm just going to move on to when the Fed have pivoted in the past and started to cut rates, and what people think is going to happen this time because of what's happened in the past and my view on that. So let me just jump onto this famous photo. It's been circulating Twitter. It has circulated Twitter a lot. It shows every single time the Fed have pivoted since the 1970s. There's been quite a big decrease. Well, not every time, because there's a few times here that they haven't highlighted, but a lot of times where the Fed has pivoted, there's been a sharp downturn in the S&P 500. 36%, 48, 27, 51, 58, and 35%. However, one thing I'd really like to take into consideration for everybody is the structure of the chart when the Fed pivots in the past. I personally believe that the downturn is already happening, and then the Fed pivot to try and stop the downturn from happening so badly. By that, what I mean is, I don't think personally that it's the Fed pivot that causes the downturn in the S&P 500. I think there's some sort of underlying economic problem in the economy, and then the Fed pauses, and then it looks like it's the Fed's pause that actually brings down the S&P specifically. For example, if there's like a lack of liquidity in the market, for whatever reason that might be, like in '08, let's say like housing market or COVID, people like rush into the exit, then the Fed like starts to flush liquidity into the market to stop places imploding, etc. So although it looks like it's the Fed's pivot that brings the market down, I believe that it's actually the market that's coming down and the Fed's pivot's trying to like stop the market from coming down so fast, or start to provide a buffer to companies that are like starting to collapse or feel financial strain in terms of the liquidity on their balance sheets. For example, like what's been happening with the banking sector. Yes, they haven't pivoted interest rates, but they have started to like in a way like ease banks, even though they're not calling it quantitative easing, but they have like eased on their balance sheet. When we started to see like Silvergate Bank and the likes collapse last month, they instantly flushed capital or liquidity back into the market when it was needed, and they basically said that they would buy anyone's government bonds off them at the price that they paid for them in order to help with any sort of problem. So what's my point with this? My point with that is, if we have some sort of downturn, if we have a Fed pivot in the future, it doesn't necessarily mean we're going to automatically have a downturn in the market. I feel the downturn in the market would come from the Fed pivot specifically. And I'm going to get onto that a little bit more in a second, but I just want to show you what I mean in a structural standpoint with the S&P. So this is this chart. This is the SPX. So it's just an ETF of the top 500 companies in the US. And as you can see, every single time this Fed pivot has come in, they're marked by the vertical lines. And I've double marked this one because it was a big pivot. Look, this is where we're all the way up here with interest rates, look, all the way up to nearly 20%. I don't know if we quite crossed that, like as I said. We're all the way up here, so that's why I double marked this one. But so we've rallied up, and then we have the pivot, and then we come down. Again, rallied up, the pivot, come down. Rallied up, pivot, come down. Rallied up, pivot, come down. Rallied up. We did actually set a slightly higher high here, even though you can't see that very easily on the weekly time frame. It is slightly higher, just here. That's in 2007. If we rallied up, pivot, then coming down. We rallied up just before COVID, pivot and come down, and now we're here, and we have had this. This is like when they were contracting the balance sheet and liquidity from last year. We've had this pullback recently in the S&P, and we're on the rally up. So today was when, or yesterday was when they paused the market. So one thing that would automatically be different to what they've done in the past is if they paused or pivoted here, it isn't actually at the top, at a local top. It would just be on a retracement, which they've never done. Well, they've not done since the 1970s. So that's the first thing. So does that mean that they can't do it? No, of course it doesn't. Does it mean that it'll affect the market any differently? No, I don't know. It just means that it will be different. It means that, I know they've said they're going to keep hiking next month. I don't think they're going to do that. That's a different topic for a different day. But what I'm saying is, this isn't the time, if we compare to all the previous hiking cycles, or sorry, relaxing cycles, this isn't the time when they'd be pausing or pivoting. So they've paused. Where would the pivot come in? Maybe we rally to new all-time highs, and then they pivot, and then we come down. Potentially, that would make sense technically in comparison to what we've done in the past. But that's just something that I want you guys to take into consideration, because we don't have the same setup and structure. It would have been more obvious if we'd if we'd actually been raising rates, and then we started to pivot here because we saw a problem. But we've actually done the opposite here. Obviously, the raising rates has took the liquidity out of the market. It's made the stocks collapse, and now we're on the retrace already. We've already been retracing anyway, and we are then now pausing with interest rates, because the main target for the interest rate raise was inflation from Jerome Powell and his cronies, and that looks to be being tamed, and I'm going to talk about that in 1 second. But that's basically my technical, or like the structural difference between this time cutting interest rates and the time before. So I hope that makes sense. I hope I've communicated that well. I don't know if I definitely have. But let's get into inflation. If we look at inflation, it's at 4.5% year over year. And if we go back to, let's say, the peak, which is June of 2022, it was at 9%. So we've actually brought inflation down by 5% in a year. This sticky inflation that everyone's talking about. And yeah, okay, we've raised interest rates to 5%, so you could say that's the reason why. Who knows? Like, only time's going to tell. If we look at month over month inflation, the average is 0.3% a month, or 0.29%. Last month we had a 0.1% increase. If we have another 0.1 or 0.2% increase this month, we will bring year over year inflation down to a number starting with 2, so 2.9-ish% inflation, because our month over month last year was 1.19%. If we have a 0.1%, we will have a 2.9% inflation, and then that sticky inflation number that everyone, or the sticky inflation narrative that everyone is really attached to, is going to look a lot different if we have a 0.29% inflation. I'm not saying it won't then increase for a few months. I don't know specifically, but I'm just saying there's a definite world where we've paused this month and we could still see 2.9% inflation next month, which is a lot different to the 9% that we were looking at, which was the boogeyman in the closet that everyone was scared about last year. So if we get that environment where inflation is then at 2.9%, which is very close to the 2% goal, do they bring interest rates down because of their national debt so high and they want to keep stimulating their economy? Because as far as I'm aware, one of the things that they use to be able to justify like a debt ceiling increase, I think they've extended the debt ceiling for like a year or two. I'm unsure on that exact debt ceiling increase, but they use collateral such as their equities markets to be able to go to like the IMF or whatever and say, look, we need to increase the debt ceiling. They use the stock market and be like, look, this is the value that we've got. We need to increase debt ceiling by this much. And then they're increasing the debt ceiling then is a perpetual cycle, flows into the equities markets and other things. And then they do the repricing again to be able to be reissued the debt. But they don't want to be paying huge interest on their own national debt of like 1.5 trillion a year, because America is not making that money right now. So my point basically is with inflation is that I think we've beaten the top of it. I think that it was mainly supply side, meaning that when we were all locked inside, say like businesses shut down in China that we saw, this made it more difficult to ship things. This meant that, for example, retail stores ordered as much inventory as they could get, stocked at the shelves. They didn't know when they were going to get more. Then this gave them a big backlog of supply. It made shipping prices go up because everyone was competing for container space. All these sorts of things, and the same with there was also a commodity squeeze because of the Russia invasion of Ukraine. We saw oil fly up. Oil flew up to like the hundreds, and now it's down to like $60 again. Like all these sorts of things pushed into a pie that got pushed onto the retail investor or the consumer, and now they're starting to be pulled away, and competition is back out there again, and people are spending less out because they have less money. Like wages haven't increased at the same rate. So I think the wage difference between like this year and last year, people were feeling the pinch, they're spending less, and then in turn that brings down inflation. I know the numbers aren't necessarily reflecting that yet, but I think they will very soon. So that's going to basically do it for my macro, like short-term macro. I'm more eloquent, I'd say, in my newsletter. I find it a lot easier because I can just relax and talk. Here on video, and my mind's working at 1,000 miles an hour, and I'm just talking about all sorts of stuff. So now I'm going to get on the technical analysis side, specifically with the S&P to start with, then the DXY, and then we're going to move on to crypto after that, because DXY I think then links us nicely onto the crypto space. So let's do it. So just to start with, look, I was talking about oil. This is when Russia started to move into Ukraine. We had a huge spike up from like $66 up to like 124, and now we've come all the way back down to 68. Are we finding support here for another push higher? Only time will tell. What's going to happen in the future with oil? I personally think that we might just chop around here for a little while while things start to work out. We could have set a lower high in oil and potentially be coming down to test some further lows around 55. But I just think we'll chop slowly down to 55 unless like OPEC plus or something major happens out there. And jumping into the S&P, which is something that I really want to talk about. Oh, the reason I was talking about oil specifically there is because it's one of the extra commodities that add into the basket of problems that we've had. And now jumping into the S&P, something I've been writing about literally since October, and when I was telling people in the newsletter that I thought the lows were in, and I talked about China and Chinese liquidity and how their stocks had turned just before the US's had, and that they were leading the liquidity. I've been saying that we've been forming higher lows on the S&P, and I thought we will continue to these higher lows and continue to set all-time highs. And I literally said that debasing currency, we keep printing more currency and increasing debt, and with the increase of debt, equities in turn should increase in value. That's why literally stocks always go up. If you look back to the start of time, yes, there are some big drawdowns, like people were talking about in the 30s, which isn't being shown here, but it might be shown on the SPX. Let's quickly see. People are talking about in the 30s when there was like a big crash, or where are we? I don't even know if I'm going to easily find it here, so this could be a bit of a waste of time. Yeah, so in the 30s, look, we had a big crash, and people are scared of that, and they're waiting for that. Then you got a lot of people who were caught in the 2008 crash who are still in the markets now, who are like expecting this as well. And I think it's much different now to 2008 because the amount of debt that we've got, and everyone's tied in with each other. And we talk about cycles of money. If you look at Ray Dalio's like Changing World Orders and the Economic Machine, where he talks about the life and death of a fiat currency, which again I think is kind of another topic, but I just want to quickly touch on it. Basically saying that fiat currencies only last between like 75 and 125 years. We are in that cycle where a fiat currency is going to die being the dollar, but I just don't think we're quite there yet because we haven't reached the point of mass printing or hyperinflation. But before we do, we should see the stock market rally heavily if we were going to see something like that, in my opinion, because the stock market is being priced against the dollar, and if the dollar is being printed into oblivion, which could happen at some point one day, if we especially have bank failures, then the stock market should rise with that, unless we have a complete economic collapse, and then it's anyone's guess at what happens because everyone's holding US treasuries. What happens around the world, unsure. I think the dollar is going to bleed out slowly, not necessarily just pop overnight, but again, could be wrong there. If we look at the S&P on the monthly, we have formed a bullish cross on the RSI, and the MACD is going to cross bullish for the first time in a long while, well, since like the recovery from COVID-19. So to me, that spells a push to the upside. As I said, and I've actually broke it down in one of my newsletters a while ago, I gave some price targets for the S&P all the way up at like $641 based on the amount of like circulating supply of dollars and the amount of capital being printed, and this isn't a short-term price target. It's just where I think if we're going to get like a big push over like a few years, that's where I think we could go. If we look at the weekly time frame, we've formed high lows multiple times. We've broken through a key resistance level recently, which was holding us down here for like a year, all the way back from August of 2022 for like a year, and we've broken through that right now. However, we do look to be nearly in the overbought area for the weekly S&P. One thing that I would like to point out is on this rally up here, looking at this little section, this is a space of about a year, and we spent that whole year up at the top near the overbought section on the weekly for the RSI. And in that time frame, we actually rallied. Let's see if we take just when we touch into the overbought area there. If we just go from here to where we last touched the overbought area, we rallied like 30%. If we were going to do that same sort of move, we're not quite yet in the overbought area on the weekly. So let's say we just join it maybe next week from the price action that we're at now. We join it next week and we rally 30% before we start to retrace in a year. We could be at $573 for the S&P. So let's see if that happens. Obviously, on the other side of the spectrum, yeah, we could rally up here. We could have something similar to what happened in this area here, how this is where the Fed cut cut rates and we crashed. We rallied up, just set a new all-time high, Fed cut again, and we crashed. Obviously 2008, people were trying to compare it to that. But even in that scenario, I do still feel like we break all-time highs. So let's say we go another 10 or so % before that starts to happen. So obviously, again, I could be wrong, but that's what I'm basically looking out for, and that is my base case right now. Exactly how we get there, I'm unsure, but that is, again, what my base case is. Further in that, I just want to talk about the DXY a little bit. I've talked about this a little bit on Brad Kimes' show the other day, Digital Perspectives. If I was going to give my base case of argument technically for what the DXY is doing, I did say that I thought we'd stall out a little bit around 100. And that is exactly what we did. I called that about 3 or 4 times in the newsletter. If we were going to continue this move, we've taken a plunge into a descending triangle. This is the length of the move. This would be the length of the target. If we broke through the bottom of this triangle, we would be looking at 89 for the DXY. We're also stuck underneath some key resistance, which obviously has been acting as resistance since 2016, 2017. Took us a little while to break through it on the way up. Now we've come down, broke through it. Did have a weekly close above it, then quickly came back below, stuck between the 100 and the resistance. Now, if we look on the weekly time frame, we could be coming down and we could have some more pain to come if you are along the dollar. If we look on the monthly, this is my personal opinion, obviously, guys. If we look on the monthly, it's crossed bearish on the MACD. We are holding just above the 50 on the RSI, which means we're still in strength. But if we lose that 50, we could come a lot further down again to lows that I'm talking about, around here at like 89. And if we also look on the monthly, we are creating a series of lower highs with a secondary lower low. Could we come down and set a lower low than that? Potentially, but it won't be in the immediate term, in my opinion, unless we have a complete capitulation. But I also don't think that's going to happen. There is obviously a world where we have cross bullish with the MACD. We could gain some strength here off the moving averages because we didn't lose the 100-day moving average. We could again touch that and then start to push up towards a double top, or maybe even setting a slightly higher high. If we do break 112, we're looking at least 120. So there's a world where that happens too. But my base case is that the DXY comes down because I think we're setting up for a crypto run as well, specifically. So now getting into crypto, what I firstly want to talk about is Bitcoin. A lot of people are bearish on Bitcoin right now. We are actually, even to this point, well, the highest rally that we had, we rallied about 100% from the bottom to about 31,000. And right now from the bottom, we're up about 60% at about 24, 25K. We have lost the moving averages on the weekly time frame, but something that really interests me on the weekly time frame is the lack of volume coming in when we have lost these supposed key support levels. No one's really pushing the sell button too heavily. And if we go into the shorter term time frame, if we look at where we are on the daily, for example, yes, this support has been lost, but we're so close to again being oversold on the RSI, which for me is a bullish indicator. The last few times we were oversold in the RSI, it's been very close. On the daily, it's been practically the bottom. So potentially we could be very close to a continuation to the upside. If we take it off the logarithmic chart, if we look at this trend line, there's still a key support level here on this trend line. So somewhere around here could be good for a bounce, depending on whether you take in these wicks from this date or not. Another thing that I would like to talk about specifically with cryptocurrency is Ethereum. Ethereum is something that I've got my eye on now as the leader of the altcoins. Yes, there's lots of speculation. We've got the Hinman email, which I'm going to get into in a second, which is maybe not necessarily good for Ethereum. But ETH right now is holding the 200-day. I'm going to be interested to see what Ethereum does on the daily time frame here. On the 200-day, holding it as support at the same time as dipping into an oversold territory on the RSI, which again is actually a bullish divergence. We've got higher highs here. Potentially, if Ethereum holds this level, we've got clear higher highs there, and we have lower lows on the RSI. So that is a bullish divergence. This might be the start of a reversal for Ethereum. Somewhere around here is what I'll be looking at. So I've definitely got my eye on Ethereum to be showing us what the altcoins are going to do next. Next, I'm going to jump into XRP, and this chart looks pretty messy, so I'm sorry about that, but I've got something drawn on the other chart that I want to show you as well. I'm just going to take this Fibonacci retracement off. As I talked about on Brad Kimes' Digital Perspective show, this 55-ish cent level is acting as heavy resistance or support whenever it is touched for XRP. We've seen that in the past, and we're seeing it now. We tried to cross it when the Hinman emails came out and rejected it heavily, and now we've come back. We're looking for some support. Something that I would like to mention is that we're actually again forming higher lows. Boom, 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 boom. If we form sort of higher low here, or even test this, I presume this is the 20-day moving average. Let's do, yeah, it's a 20-day moving average. If we test this and hold this support like we did here, even if we come down to it, we're still going to have set another higher low. That means we're gaining more and more momentum to attack this resistance level. It hasn't happened yet, but let's see what happens. We've still got a little bit of time to play out. It could take any amount of time. We could just chop sideways until that comes up and pushes up as support and squeezes us up against it. We may lose that level and come down to the 50 MA, but I'm looking for a higher low here for XRP and a continuation to the upside. The only thing is we haven't cooled off too much on the weekly. However, if we go into the daily time frame, and then I'm going to show you on a Fibonacci retracement levels, on the daily time frame, we're holding the moving averages again. Could we come down and test the 200 potentially? But again, like I was saying, I'm looking at higher lows here for XRP, trying to gain momentum to really attack that resistance level. We had some big selling volume come in on the Hinman release day. Someone dumping on the market, waiting for the speculation to come through, buy the rumor, sell the news sort of thing. One thing that I do know that makes quite a lot of sense with the price action is everyone was expecting a push. So we're going to have traders sitting on the side, and whoever dumped a lot of XRP on that day sitting on the side like, cool, everyone's expecting a buy, I'm going to sell heavily. And the other narrative, a lot of people were expecting potentially the lawsuit to end off the back of these emails, and there was no smoking gun in there to say that Ripple and XRP wasn't a security, and no direct comparison of ETH to XRP. So it isn't specific for XRP, although the SEC looked really bad, in my opinion, from these emails. There's nothing in there to say that the XRP is or isn't a security. It just looks bad for the SEC, and that would probably be good for Ripple's fair notice defense if you listen to some of the attorneys in the space. But it's also good for other companies in the space, like Binance is basically showing there is no regulatory clarity in the space, and Coinbase, they can use it in their defenses too. So it is a net win for crypto in general, and it does expose the SEC. But people are saying that, why isn't the case ended? Well, it actually has nothing to do with whether the sales by Ripple of XRP were those of securities or not. That's my understanding of it anyway. There was also some bad stuff in there. Well, bad stuff for XRP holders, like it exposed how much Brad Garlinghouse has sold of XRP is like $155 million worth between 2017 and 2020. So people got mixed reviews on the emails. As I said, I think it's net negative for the SEC, net positive for XRP holders. But as I said again, there's no smoking gun in there to say that XRP is not a security, etc. Along with that, you have to think that consumer sentiment, even of XRP holders, a lot of people are like, oh, I'm not holding this asset anymore, like, I'm done with it, this case should be over. A lot of people are very emotional about it and trying to have been clinging on to the fact that this case is going to end and that it's going to send XRP to the moon. Maybe it will, maybe it won't, but you've got a lot of sentiment of people who've been holding the asset for a long time who, if you even look through my Twitter comments, TikTok comments, whatever, oh, I'm done with the asset, when's this going to end, I can't hold this anymore. And you can see that probably reflected in price action here. You have to remember that price action of any asset is essentially just people's psychology. It's people buying and selling on that day, and when Hinman emails didn't come out and settle the case, and then the price started dropping, they were like, oh, I can't hold this anymore. Emotionally, they couldn't be attached to the asset any longer, and they continued to capitulate when they saw the price coming down and not going up on the day of the release of the email. So you have to take those things into consideration as well when you're trading any sort of asset. But technically, as I was saying, it's creating higher lows, and I am actually bullish on this structure. We're holding the moving averages. If we look at the 4 hourly, we have a bullish divergence. If we hold this level here, what we can see is a clear, let's get rid of the MACD for now. What we can see on the RSI is a clear higher low and a clear lower low on the price action. So this is actually a bullish divergence again for XRP. So could we be holding this level for a reversal? A lot of volumes coming in on these big selling candles. This one had a big wick back to the upside. So let's see if we can see some sort of reversal here. But it mainly does rely on the efforts of Bitcoin to see where, see what Bitcoin can do. Can Bitcoin find any sort of support around here? Again, being oversold on the 4 hourly. Let's keep our eye on that. Finally, another crypto that has a big bullish divergence right now and is in the absolute mud, as are NFTs, is ApeCoin, which is in the oversold area, has formed a higher low on the RSI and a massively lower low on price action. You may be able to suggest that this could be some sort of area of interest for anyone looking to scoop up some ApeCoin. It's probably something I'm going to be looking at very soon, and in my next week of trades, I may write about this depending on what happens in the next few days. Remember, let's not rush into trades here, but let's just keep our eye on exactly what's going on. And finally, the last thing I wanted to talk about was the total market cap of crypto in general. We've been coming down since our recent spike up on the 23rd of April. We've been slowly depreciating since then. And again, we're about to touch the oversold area on the RSI. The last time we touched that was back here in about the 10th of March, which is when we set our low before pumping up all the way about another 43%. So will that happen again? Potentially. That's what I've got my eye on right now. We have just lost the moving averages. It's kind of a similar structure to what we had back here. So I'd like to see some sort of bullish momentum come back into the market now and really push us out of this zone. If we take ourselves also to the weekly time frame on the total market cap, we are holding the last weekly support level, which is the 50-week moving average. Let's hope we can hold this and see if we can push up to the upside. There's a lot riding on the next few weeks in crypto. I personally believe, as I was saying, that we have less of an issue in the market than we think. The SEC and the US are throwing the absolute world kitchen sink at crypto to try and crush it. If we can hold these levels, we're looking good for a continuation to the upside, in my opinion. We've got people like China, for example, who have this week released $29 million worth of digital securities on the Ethereum network. They have opened Hong Kong for trading. We've got Russia's biggest bank opening its doors to retail trading of crypto and settlement cross-border. We've got Australia rolling out their CBDC with NAB Bank doing with their first Australian dollar stablecoin transaction this week. There's a lot net positive for crypto happening all around the world. With Hong Kong's digital dollar, we've seen Ripple integrated and demonstrating tokenized housing. There's all this sort of stuff coming to the market very soon. Can America shake the price down further? Is there a bigger agenda for America? Are they trying to bring in some sort of exchange like FTX 2.0 or JP Morgan exchange? I would not be surprised to see anything like that. But without further ado, guys, that is going to be the end of my video. I hope I've covered everything I wanted to. I feel like I probably will be in the comments of my own video commenting things that, oh, I forgot to say this, I forgot to say this. But I did my best to try and sum up all my thoughts right now. If you have any more questions or I've not been very clear on a specific area, please drop me a comment and I'll do my best to answer that for you. But yeah, I hope you guys enjoyed the video. If you did, please retweet, share, like, comment, whichever platform you're watching this on. And I will see you on the next one. Peace up, A-Town down, as Usher would say.